It's Fed Day, and we just heard from Chair Jerome Powell the Fed is cutting 25 basis points. But it's not about the cut, it's about the messaging and the reason behind it. Because what I want you to understand, and I mentioned this in yesterday's show, it's about the trend. And right now, since late 2021, the U.S. economy has continued to decelerate. And the problem is, this is not going to end well. And right now, nothing's really working. Nothing's changing the trajectory of the economy. Now, it moves down and plateaus and moves down. And every time we hit a plateau, everybody says this is the bottom. And the reason, my friends, I'm telling you, this is not going to end well, because if these rate cuts do not work, we've got a huge problem. But let's talk about what Powell had to say today, because as expected, as I predicted, the Fed was going to cut 25 basis points. And what we're hearing now from the FOMC is they're signaling that more cuts are coming. Now, they're saying this despite the fact they're projecting inflation to move higher. And of course, this is a bit troubling, because if indeed rate cuts lead to higher inflation, which we know doesn't actually happen, but that's not the perception, that their policy here doesn't make a whole lot of sense. In fact, the Fed's saying it won't be for a couple of years we get back to their 2% target. The reality is, if we hit a recession, and that is the real risk here, if these rate cuts don't work, we're not going to have a problem with inflation. We're going to have a problem with the labor market. But as I mentioned yesterday, if we're getting cuts based on inflation, that it is bullish for the markets. In fact, the reaction from the S&P and the NASDAQ today, well, were fairly muted, which is a bit surprising for a lot of investors. But if we're getting cuts because the labor market's weakening, and that's exactly what's happening right now, it's a bearish sign. Now, it doesn't mean stocks can't rally over the next couple months, but what history tells us is that we're closer to the peak and entering a bear market than we've been in years. But let's talk about the messaging from the Fed. They noted today that recent indicators suggest growth of economic activity moderated in the first half of the year. Now, again, we've seen the economy decelerate at different rates. But if you go back over, say, about the last 12 months, what we find out is it's actually plateaued. And the evidence is pretty clear. Yes, inflation picked up a little bit, but the real issue, it's the U.S. consumer. And what have we seen in the labor market is the fact the job growth has been rather muted. And on top of that, average weekly hours have been rather stagnant for about a year now. And this is a real issue facing the U.S. economy, is you had all this inventory building. The problem is paychecks didn't build in a matching way so consumers could continue to spend. The risk isn't inflation. The risk is, as Powell said, look, we just saw the non-farm payroll report revisions, and it told us that the U.S. economy is far weaker than we thought. That's the problem, is we're headed into a recession led by the fact that millions of Americans could be laid off here. Because when we look at the inflation dynamics, it's all about demand. And what have we seen since 2021? Inflation continues to fall, but right along with it, hours worked decline. Then they kind of both stagnated here over the last year, but we've seen consumer credit really driving spending as consumers look to front run the tariffs. The Fed also mentioned that job gains have slowed and the unemployment rate has edged up but remains low. But notably in their projections, they said that they thought the unemployment rate was going to continue to rise until the end of the year, and then it was going to start to decline. Now, this is baffling somewhat because, well, we've already had 50 basis points of cuts. Now we just got a 25 basis point cut. So the question is, why is the labor market going to continue to weaken if the Fed is cutting rates and that's supposed to stoke economic growth? Well, the real answer, my friends, is it's not going to work. And the problem is, if the unemployment rate does keep rising, and based on all the leading indicators and all the survey data that we have, it indicates that that is highly likely to happen. Particularly if you think about it from the consumer perspective, we've been hearing from survey after survey that spending over the holiday season is going to decline. Well, that happens from a business perspective. You don't need to order a lot of stuff from the factory or from the wholesaler, and you may not need as many employees. And again, if you look at the direction of the economy here, and you think about the Fed's move, is they're worried about the labor market. Again, that is the most recessionary signal you can get. But how about inflation? The Fed notes that inflation has moved up but remains somewhat elevated. And Powell's real concern here is that they thought inflation was going to rise a whole lot due to the tariffs. Now, if there was going to be any likely shock, it would be a one-time shock to the system. But even today, Fed Chair Powell said, look, we're concerned that a potential one-time shock that, mind you, we really haven't seen in the system is going to lead to persistent inflation. Again, that doesn't make any sense unless you believe that U.S. consumers can afford an inflation shock and then will continue to spend. But so far, the effects of inflation have been largely muted because what have we seen all across the supply chain from the manufacturer down to the retail level? What have we seen? They're absorbing the tariffs, and for good reason. Now, even if the Fed cuts into a recession, we are changing the way people trade. And right now, our optimized meta strategy is crushing it. I want to show you another trade we put back on the 10th. This went out to all our subscribers on symbol DAPP. We told them to buy at the open. That trade, as of close of business yesterday, up 10.93%. And again, we're changing the way people trade. In fact, right now, I'm working on a brand new optimization engine for the meta strategy. We're incorporating Momentum Timer Pro. I just built it in, and it again is going to blow the doors off of any other trading strategy out there. Now, you can get in on these trades right now at no additional charge. Grab those links in the description below. Sign up for either report. Be sure to use a coupon code for your free 30-day trial. Because what do we continue to hear at earnings announcements? We hear this from corporate executives all over the country. U.S. consumers can't afford higher prices. In fact, even McDonald's knows that people can't afford a Big Mac, so we have to package it in an extra value meal and give people 15% off and charge $8. But the question is that going to work? Yeah, I don't think it's going to. I think the situation for the U.S. consumer is far worse here because in the end of the day, if companies cannot pass on higher prices and you have employees demanding higher wages, at some point something has to break. You know, we've been talking about how companies are going to defend their bottom line. They're also going to defend their purchase of their own stock or their corporate buyback programs. To do that, they're going to have to lay off. And I think when we look at the energy sector recently, you see a lot of these oil companies laying off. That is the big leading indicator, is they're saying, look, demand isn't there, so we have to get our cost structure under control. But watch, they're not going to cut their buybacks. Now, when that happens, well, watch out. Stocks are going to plunge right along with it. But right now, we had a 50 basis point cut already on the books, and it did nothing for the economy. And that's the key point here. Because as people look to this next cut and they say, all right, well, maybe this 25 basis point cut will make a difference. But the reality is, if you look at what the 50 basis point cut did, it actually made inequality worse. Because when we looked at the last retail sales report, what did we find out? That half of all spending is done by the wealthiest Americans. Now, did that rate cut actually help low-income Americans? It didn't. In fact, they saw their hours get cut and then spilled over into the middle class. So the real issue here is that rate cuts aren't really working at all. And when we look around the world, we see, of course, central banks have been cutting. And that's how we knew the Fed was going to cut here. Now, we just heard from the Bank of Canada, they just cut rates down to 2.5%. And I want you to hear what Governor Tiff Macklem had to say. He said, with a weaker economy and less upside risk to inflation, the Governing Council judged that a reduction in the policy rate was appropriate to better balance the risk going forward. So what they're noting here is exactly what the bond market's been telling us. That growth and inflation are coming down. And we talked about this yesterday, that if you want to understand what the economy, what the bond market really thinks of this Fed rate cut, watch to your Treasury yields, because if they continue to decline after this meeting, what it says is the Fed's going to cut again and again and again. And that's what we're seeing from central banks all around the world. In Canada, they've got a weakening labor market. In the U.S., we have a weakening labor market. You see it in Germany, you see it in China, you see it all over the world. In fact, Catherine Judd, she's an economist at the Canadian Imperial Bank of Commerce. She said, quote, in our view, the economy is losing resilience and inflation will continue to be contained by the elevated unemployment rate and removal of retaliatory tariffs, and we therefore see another 25 basis point cut in October. And my friends, that's what I've been saying all along. If you lose the labor market, and that's where we're at now, what happens to inflation? Well, it doesn't matter, because a business can raise prices all they want, but if nobody comes in to buy, they're going to be the ones out of business. And this is exactly why you're seeing in China, you're seeing manufacturers compete over customers, you're seeing price pressure go down. That's why we see producer prices in China continuing to decline. The problem is we're going to see that here in the U.S. The issue is it's going to come at the sacrifice of U.S. workers. But let's talk about the 25 basis point cut, because throughout history, we've always known the Fed is the last of the party. So a lot of people wonder, why isn't the Fed leading other central banks here? It's not what they do. They let the rest of the central banks cut, and then they come in and react. So no surprise to me, we got a 25 basis point cut, just as I predicted. And you look at the reasons why, the 2-year Treasury told us everything. And again, the Fed doesn't like to do outsized cuts because it says they're wrong. And the messaging they want to tell the world right now is, hey, we're on the right path. We think a little bit of a cut here matters. In fact, Fed Chair Powell went on to say that he thought that they were still in restrictive territory, and there's really good reason for this, because he doesn't want the markets to overreact and freak out here. Because if you lose the stock market at this stage in the cycle, what happens to all those retail sales numbers that are being driven by the wealthy Americans? Well, it's going to come plunging down. Now, in terms of dissent, Cook, she was right in line with Fed Chair Powell. In fact, everybody was in line. But you remember yesterday we talked about Stephen Mirren, who Elizabeth Warren said was just a puppet for President Trump. Well, he came out and he said, look, I wanted to cut 50 basis points. So I want to know what you think. Was he on the right side of this and the rest of the board is completely wrong? Or is he actually just being a puppet to President Trump? Or is there some other reason? I'd love to hear from you. Weigh in the comments, because what we're seeing now from markets, if you look at market expectations and where rates are going, they're saying, look, there's going to be one more cut by year end. My friends, I think there's going to be a whole lot more cuts, because right now the labor market is decelerating. Since 2021, we steadily have moved down. The economy's continued to decelerate. It's plateaued. The problem is everybody thought this was the bottom. I think we're beginning the next leg down, and that one's going to involve the Fed cutting aggressively. And the evidence is clear as we now turn to the housing market. Today we got housing starts. Remember, we talked about the housing market yesterday, how builders were desperate for a rate cut. They really need to see that happen. A lot of it is because they need to refinance all of their existing loans, because remember, they're sitting on the largest amount of unsold properties in the history going back to the financial crisis. On top of that, they think a 25 basis point or 50 basis point cut is all consumers need to come out and flood in and buy homes. And again, I don't think that's going to work at all. I don't think that's the real issue here. But in terms of price cutting, because that's what we're seeing from builders, they're using incentives, and now we're seeing almost 40% of builders cut prices. You think about the resale market and those that need to sell for various reasons. Maybe their job's moving, maybe they have to move for other reasons. They're now facing competition from builders, and that's one a lot of homeowners cannot compete with. But let's talk about the labor market here, and I want you to go through. We're going to look at some of the data that just came out on the housing market. New residential construction down 8.5% month over month. Huge drop. One family homes down 7% month over month. Multifamily, and I think there's going to be a huge bubble in multifamily, and I know a lot of people say it's not likely. A huge demand for that. Starts dropped 12%. That's staggering. Again, you're talking about oversupplying the market here, and building permits, as you look out in the future, those dropped 3.7%. And the real issue here, you talk about the housing market. It employs millions of Americans, but it's not just the housing market itself. You've also got to think about the fact when a home's built, what do you have? Appliances, air conditioners, those are called durable goods. This all backfeeds right up the supply chain, right to the manufacturing level. My friends, the risk here is as builders now cut back because they have to clear inventory. And I want you to draw the parallels. As they cut back, what do you think on the retail side is going to happen? On the wholesale side, everybody's got to cut back to clear their inventory. What does it mean for the labor market? Well, what you're going to see is a lot more people are going to have their hours cut. You're going to see jobs lost. And so from the Fed's perspective, that they think, hey, we're staying kind of somewhat restrictive territory so we can cut rates again without scaring anybody. The reality of the situation here is the U.S. economy is decelerating again. Rate cuts are likely to have absolutely no impact. And this is why you want to look at lower rates and the impact they're going to have on the economy. Now, today we also heard from the Mortgage Bankers Association that said refis are up. No doubt people are looking to save money, but are they going to cut their payment enough? Not a chance. It's not going to make a difference. And this is, again, one of my arguments that we're headed all the way back to zero, because if the economy heads into recession, you're going to have to free up cash flow to get people to spend. the easiest way is to cut rates. So right now, as we look at the housing market and we look at the economy, we look at the Fed's move, it's all about the labor market. And the problem is right now, wages aren't keeping pace with inflation. We're seeing hours drop. We're seeing more concern that people are going to lose their job. They're not going to be able to get back into the labor force. And if you want to talk about a rate cut and its effectiveness, I can tell you right now, there's nobody out there who's worried about losing their job that thinks a quarter basis point cut's going to save them. Problem is, my friends, if these rate cuts do not work, watch out. We're headed right into a recession. And I just want to say, I warned you this was going to happen, and now you're seeing it in real time. Now, I want to share with you how we are changing the game when it comes to trading, showing you how to put more money in your pocket with higher probability trades. Let's take a look at the backtest results. Now, this is from our optimized meta strategy, which right now I'm under the process of building a brand new optimized engine for it. It's going to blow the doors off of anything. Right now, check this out. It has a win rate of 66.7%, and this was a 3-year backtest run on SPY, generated 69 trades, had a max drawdown just over 7%. And a total return, look at that, 71%, beating buy and hold. Again, that's absolutely amazing. Now let's compare this to the popular Bravo 9 strategy run by my buddy Jay Bravo. Look at this, total return misses buy and hold strategy, half the number of trades, and look at the win rate, pretty paltry compared to what meta strategy generates, and the same downside risk. So again, my friends, if you're paying for other strategies, it's time to make a change. Because what is my meta strategy? Well, right now, it's an advanced trading system that combines 9 professional trading strategies, about to have 10 as we just built in the Momentum Timer Pro algorithm into it. It's been fully optimized, and now we're going to optimize the already optimized meta strategy. We're going to take it to a whole new level. Bottom line is it generates more frequent buy signals. It's optimized for a target hold period of 10 days, generates hundreds of trades per year, and has a success rate, as you can see, over 60%. Again, compared to other strategies, there's absolutely nothing like it. Now, how do you get in on this? Well, you got to sign up for one of my reports. Now, if you want to trade against the machines, it's called CTA Timer Pro. You like trading momentum indicators? Grab Momentum Timer Pro. Either way, you get the daily report for both of those. You get the tradable signals. You get the meta strategy trades included right now at no additional charge. You get my opinion on the best trades. You get risk control levels, a full tracking of all open trades and returns, a weekly update. And again, here's the best part. You don't even have to put a dime out. Whether you're new to trading or maybe you just want to compare this to your existing platform and see how it blows the doors off of it, use the coupon code for your free 30-day trial. Again, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.